Hey everyone, welcome to the newsletter for March 21st. So we're going to do our usual run through of the Glassnode charts, and something that I've actually found a little bit interesting. Obviously with on-chain data, the reality is that it is trading the hard right edge, right? We've got new information coming in all the time. We have to take it as it comes, and you've probably noticed over the last couple of sessions, we've really looked at are we in a bit more of a longer term consolidation? What is the overall market patterns that's going on? And we've certainly gone for a period of time where it's very, very hard to find a bear case. As of last week, there's a little bit of question marks as to, we're certainly getting a slowdown of long hand selling, and overall it's still pretty bullish. But what I'm actually starting to see is a pattern that's, to be honest, again, it kind of sounds like a broken record here, but something is developing here that looks very, very promising. So let me run you through a few charts, and there's just an interesting fractal, which we can actually see down here in the realized cap hodl waves, and we'll look at this in more detail. But importantly, you can see this lower high that we've got going on here on these two orange bands. Now, we'll come back to what that is in more detail, but what we're really seeing is actually a change in momentum that's occurred after the 42,000 peak. And it's actually a very positive change. So very, very high level, just so you can kind of see where this pattern is going. With our realized cap hodl waves, the darker the color is, these warm red colors are young coins, and the lighter green colors and the cooler colors are essentially older coins. Now, this particular band here, this orange band that you can see is actually putting in, so you've got this dark orange band and then a lighter orange band. If you can see how the dark orange band is putting in a lower high. Now, they're very young coins. They're 1 week to 1 month old. So talking about, you can more or less say within the last consolidation, they will come into that band. And this is the thing with these hodl waves, it takes time for coins to mature into different bands so we can see how they transform. But importantly, the orange band, the light orange band, is actually expanding, whilst the younger coin, the darker colors, are actually receding. And what that's telling us is that we've actually got accumulation going on up here. There are coins that were purchased a month ago that are now being accumulated and hodled. So that's the trend that I think I really want to touch on today as we run through. We're actually going to go through a bunch of these different dashboards. There will be some overlaps because I kind of use them for different things, but let's start with this. This was the original one that I set up for whale watching, just understanding what some of the big balances are doing. And you can see that there's probably two interesting trends we've got here. One is that, and again, remember we're talking about a scale of a few hundred wallets here. The number of addresses with more than 10,000 has been in this steady decline. I don't fully understand the mechanism of what's going on here. I suspect that this is actually, this reduction over time, I actually think that this is exchanges, because you can see we had our initial March 12th sell-off at this point here. Exchanges relatively went sideways, but we've really seen the depletion from that point in time. So they would have had a lot of cold wallets set up with, their 50,000, 30,000, whatever BTC in them. And they'll have a bunch of different cold wallets, so they'll have different setups. But over time, we've got institutions coming in. So I would not be surprised if some portion of these, this is really happening after 20,000, and we know that that's when institutions really stepped in. I would not be surprised if this is actually exchanges reshuffling around their 10,000 plus coin wallets as a result of institutions stepping in and buying 2,000, 3,000, 500, 10,000, 15,000, right? We're talking about numbers that are equivalent to this being purchased by large whales, essentially new players coming into the market. Now, in that same period of time, so we're talking about here, we're really talking about let's say 10 wallets, right? 20 wallets from the peak, 110 to 90. We're talking about 20 wallets, 20,000 coins, right? That'll be 200,000 coins. Now, if we're now looking at our 1,000 balance, coins with 1,000, we're talking about a scale of a few hundred wallets, right? So a few hundred wallets that have 1,000 plus. So this is really institutions really picking up coins. Now, this trend down is also quite interesting. I do not believe that they're selling. What I think this actually looks like to me is wallet consolidation. So when you're a custodian, you're going to have your own internal wallet systems. They're going to be, some of them may go and become a leverage collateralized loan. Some of them may go into cold storage. There'll be a bunch of these different layers and multi-sig setups and all that kind of thing. So there will be some whales that have essentially liquidated in this 60,000, 50,000 range, but I really don't think this is a selling off per se. We're seeing an uptick, and again, we're talking about it on a scale of hundreds. We're seeing an uptick in the wallets with 100. Now, the uptick in this doesn't necessarily account for this, and that tells us that there's a little bit of distribution going on. But there will be some wallets that are being shuffled around for various reasons, right, and put into different clusters. So overall, I think the general wallet movements, they're interesting to keep track of, but I really don't think they're telling the whole story. Now, we mentioned the other day that the grayscale discount has kind of stepped in, and my general view is it's likely to persist probably close to par, right? So I think we've got a discount now. I do think we're going to look back at this grayscale discount and institution will realize it was actually a buying opportunity. Our balance and accumulation addresses, again, just continues to go up. Let's look at 6 months. We've got a slight peel off up the top here. We seem to see this, right? We have this initial rally up to 42. We get our consolidation. We get a slight sell-off as we kind of get the initial repump. So we get the Elon candle. We get that next rally up to, what was this, 46,000. So really not that high. And you get a few people who kind of think the top is back in, right? They're not quite buying the rally, but then it just keeps going, right? So we've got this consistent accumulation over time. You can definitely see, if we take a 1 year view, that it may be starting to slow down a little bit. But again, I really think that if we get a solid move higher, it's only going to reconfirm that trend to the upside. So we'll come back. We've touched on the realized cap hodl waves. We'll come back to them in more detail. Yet again, our exchange balance continues uninterrupted. So there's that's again, it's giving us indication that there's still value coming out. The trend has slowed slightly, but that would make sense, right? We're now talking about higher prices. You just literally need more money to be coming in to actually be affecting these things. When we're looking at our time-based metrics, so miners are relatively stable. There's not really a great deal of change there. Let's actually just look at year to date and just see what's going on. So again, they're kind of back into semi-accumulation mode. Now, in terms of our time-based metrics, I might actually jump across to our on-chain Jedi Council for this. If we look at our short-term holder SOPR and long-term holder SOPR, both of them are peeling back towards zero. Now, I'd like to see this come back and reset it at zero, which is essentially meaning that old coins have stopped being spent. Our long-term holders are actually doing the same. So this is overall pretty positive. Actually, this is the strongest downtrend that we've seen in some time on the long-term holder SOPR. So that's actually telling us that long-term holders are not liquidating at this point in time. And it's kind of backing up what I'm seeing in the realized cap hodl wave. So this is starting to paint a picture that we may in fact be in a reaccumulation phase right now. And this is some very, very early data that, to be honest, I really don't think many people will have caught onto yet. So it's kind of why I wanted to bring the trend to your attention, because I mean, we're literally seeing it hard right edges as it plays out. Our ASOL and our CoinDays Destroy, which are both time-based metrics, we've been in this kind of bear flag pattern. We broke down a little bit, and now it's closing back down. So we're just not seeing an uptrend. We're not seeing an acceleration in old coins moving, and our CoinDays Destroyed on the binary basis is then peeling back down again. So again, we're just not seeing old hands just exiting, right? They are hanging in there. They don't really appear too concerned. Let's just whack a quick moving average onto our dormancy just to smooth that out. So again, our dormancy, we just don't have anywhere near the same kind of liquidation behavior that we had at the 42,000. 42,000 really was almost a disbelief rally. People couldn't quite believe that it was happening. But now that it's actually happened, I think that the game has now changed. We're just seeing fewer and fewer of those old coins moving. And overall, it's a really positive sign. Our liveliness, will come back and look at our binary liveliness, because I think that'll give us a slightly better picture. Derivatives keep going higher. So if there was going to be one risk vector, I'd probably point to the derivatives as being the main one. Funding rate is again creeping up a little bit. But again, we've got to remember that some of this portion, some portion of our futures trades is going to be this cash and carry trade that's being played out. So all of that kind of comes into play. So we're actually going to look at two metrics. So we'll come back and look at our realized cap hodl waves in a little bit more detail. But I also want to take you through, there's a question in the chat about reserve risk. So I want to take you through the construction of reserve risk and what it's trying to tell us. So then we can start to interpret a little bit more. And I'll be bringing one of these a reserve risk chart to check on chain this week. So stay tuned for that. But this is what I was saying before. So we mentioned that there's about, we're talking about coins are about aging from 1 week to 1 month. So they're coins that were literally purchased a month ago. And then we've got coins that are aging from 1 month to 3 months. Now, 1 month ago was February or mid-February, and we were getting into the consolidation prior to the Elon candle, right? That's really where we were. Let's actually just confirm and give exactly what we're talking about here. So today is the 21st of March. So if we go back to the 21st of February, 21st of February was the peak, right? That was our 57,000. So this is post Elon candle. Elon candle was on the 8th of February. Yeah. So we're actually talking about accumulation. We're talking about a month, coins that have matured into the month state. We're talking about that 57,000 peak. So post Elon candle. So let's keep that in mind. So if we take that peak, our 57,000, February 20th, you can actually see this here is what I'm interested in. This reaccumulation in the liquid supply chain, this is significant, right? We're seeing it spike up. It's getting back to levels that were at near the 20,000 all-time high, right? The last time we had this much accumulation was during that first dip from 42, which makes sense. Right, you've got a lot of people pulling off coins, thinking, "Shit, I missed the 50,000, the 20,000 breakout. Now I'm going to seriously accumulate on the big first pullback." They saw this rally higher and they go, "Oh wow, this is really not stopping." So they even bought during that rally, but then they had a massive buy-in, right, as we got that 42,000 to 29. So that consolidation was a big buy level. And you can see that hodlers essentially sold into that rally as well. So they were taking profits through that position, but we still had net coins coming out of liquid supply into illiquid supply. So there was accumulation that went on there. And this accumulation here that's basically occurred since we had our second dip is on par with, short of the full accumulation at 29,000, it's on par with any of our other major accumulations. So it does tell us that we have significant accumulation still going on, and that's what let's jump into our realized cap hodl waves now, just to understand what's going on. So you can see here, let's take our 2017. So what the realized cap hodl waves is, we know what the hodl waves, which is basically how much of the coin supply is is held by different age groups. Now in this particular chart, I've turned off everything that's older than 3 months, essentially. So if it's older than 3 months, it's not represented in this chart. And you can see that during bear markets, what the realized cap hodl waves do is it essentially amplifies the signal that we see on this plot by the realized price of that particular grouping. So to put that into other words, the more active a group is, the more space it's going to take up on this page. So it's almost a combination of your spent output waves, your spent output age bands, and your hodl waves. So more or less, it just means that if we look at our normal hodl waves, your young coins, because they represent a very small portion, because they're always on the move, they tend to get squeezed away, and you can't really see a great deal of detail. What the realized cap does is it amplifies that up so we can see them more. It makes them more visibly present on the page, and then we can go from there. So what we're seeing here, hang on, let me just close that guy off. So what we can see here in our 2017 rally, and the important thing to note, again, we've got our light orange, which is 1 to 3 month coins. And remember, they have to age beyond 1 month to turn into that band. There's a time basis so they can actually move into that band. Now, what we saw, the more dark colors we have, the more old coins have been spent to become young, right? So the higher these peaks are, the more old coins have been spent, the more long-term hodlers have exited. And what we can see is that these kind of medium orange peaks get higher each time. And this is saying that there's a larger proportion of 1 week to 1 month old coins. Yep. So these are coins that were spent at the lower bound is 1 week, at least 1 week ago. So relatively recently, that's selling into strength. Now, once they've been spent and someone's accumulated them, they will then turn from a 1 week to 1 month coin into a 1 month to 3 month coin. So what we saw in the previous rally is progressively higher peaks on both of these two orange bands. And that's saying that as many coins were spent a month ago is the same as many coins that were spent 1 week ago. So we're getting a continual, it's a trend of selling. Now, and we can actually see this in all of these, right? 1, 2, 3, we're getting this progressive heightening of all of these peaks. Even back here, 1, 2, 3, they're all progressively increasing, which is saying that the same, someone sold a week ago, right? A month passes, then they sold their next batch of coins. It's a progressive scaling out. We do not have that right now. We have a peak in the orange, right? So this is our first peak. Ignore that. This is our first peak here, right? At our 42,000 level. Makes sense. Lines up with where we saw hodlers selling in the previous market. We have a lower dark orange. We have lower dark red as well. So this is actually telling us that even the 1 day to 1 week, we have less coins converting from 1 day to 1 week, and more coins are aging into this band, which is our 1 month band, which means they're getting older. On aggregate, what this plot is showing us is that more coins are getting older than are being spent to become younger. This is accumulation. We are getting reaccumulation going on up in this realm because we have these lower peaks that have not happened in any of our previous cycles. All right, let's just zoom back out so we can see that in context. You can see this lower peak. It stands out when you actually see it from that frame of reference. So that means that fewer coins are being spent. So the coins that were bought 1 month ago at 29,000 or 57,000 in that realm, they're being hodled. They are not being respent and sold. And the proportion of old coins that are being spent is less than what we've seen in previous cycles. We still have accumulation going on. That is what this is telling me. We've got a lessening of all of our time-based metrics, and we have a reduction on our realized cap hodl waves. This is exciting stuff, right? So now let's jump to, before we do that, liquid and illiquid supply. You can actually see here that our highly liquid supply is more or less our exchange balances, because highly liquid are coins, the way that they measure the wallets is basically, have you got coins coming in and out all the time? In this instance, yes, we do. So for exchanges, that's what highly liquid is showing us. But you can actually see that liquid coins, so they're coins that are not pure dormant, right? Coins that are just, you can almost think of this as all the other service providers, right? Custodians, BlockFi, various other units who are accepting and receiving coins all the time, but they don't move them very often. They're not exchanges who've got wallets, hot wallets moving all the time. They're kind of the cold wallet side of things. So they're not quite as active as an exchange wallet, but they are not as dormant as a hodler who's just sticking them in on a cold card for 2.5, 3 years. But you can actually see that the ratio between these, the orange is squeezing in, so the red's kind of setting that baseline trajectory down. But you can see that the orange is actually squeezing in. The width of it over at this point here is less than the width was at the peak. And that's, to me, telling me there's a story going on with the custodians. The custodians are moving their coins into a more dormant state. This is what I really think this is what's going on, that we've got a reaccumulation going on. And I think the volatility up here is going to be a subject of people who are not quite sure whether we're at a top, and people who are literally accumulating. And I think that this is going to be more an institutional base that's going to be doing this. This is a really cool chart that I like. This is the long-term, short-term supply profit loss. So think about this. 100% is obviously the total Bitcoin supply. The dark blue are long-term holders that are in profit. The light blue is long-term holders that are in a loss. The red is short-term holders that are in a loss, and in profit, the dark red, and the light red is short-term holders that are at a loss. So light colors, loss, dark colors, profit, blue is long-term, red, short-term. Now, what you can see is that, let's take through a bear market. Through a bear market, you get accumulation, right? So this light blue patch that expands, these are all the long-term holders who are stepping in and buying, but the coins eventually go underwater, right? They're basically, they're stacking sats in a bear market. So they're losing until we break all-time high. And then this full dark blue is when all the long-term holders are in profit, right? Every UTXO is in profit. You cannot be at a loss. There's a few speculators who still manage to lose money even at all-time high, but that's the nature of the beast. So during these bear markets, you get long-term holders accumulating. They then move into full profit, and then they start selling. Then you get this, the overall selling space. You get an increase in the red, the short-term holders. That's that wealth transfer. This is probably more relevant. So you get long-term holders accumulating at a loss. They all move back into profit. Then they start selling into strength, right? This dip here is selling into strength. More and more short-term holders are stepping in. More of them are in profit until we get to the bear market, right? So we get to the first phase of the bear market, the expansion of this light red. That's short-term, they're bag holders, right? This dark light red is bag holders who just get completely burnt in the bear. And you can see it's very hard to remain profitable up in this top zone here. Then you get long-term holders who again start accumulating from somewhere around midpoint of the bear. They start accumulating coins, and then they move back into everyone's in profit. They start liquidating. Yep. So that's kind of the cyclical story that this is telling us. So let's look at the bottom of the bear market. We were talking about long-term holders in profit, dark blue, 40%. Long-term holders in profit, somewhere around 40%. Somewhere around 45%, right? So we're getting similar numbers as like the bottom of the bear. We're saying around 45, 40%, which makes sense. Realized cap will be underwater at that point in time. You've got less than 50% of your holders who are long-term and in a profit. More and more people are at a loss. You get this expansion through here. Now, our peak up here, long-term holders in profit, 75%. Long-term holders in profit, this was near the peak, 65. Long-term holders in profit, 62%. We got up here to 675, so very, very similar to where we were back here at the all-time high. Now, this kind of phase here, so we get to our all-time high, our original all-time high, this was 20,000. As we get the initial long-term holders start liquidating their coins, this is the trough, right? This is the point of maximum long-term holders sell. And they get down to, in this instance, 58%. In this instance, there's our peak, there's our dip there. So we're talking about this node, 55, 54%, 58%. So we're talking 55, 58, what's this? 58. Here we are at 67. Yep. So that's actually telling us that we're talking about 58 to, let's just say 68, which we're still talking about 10% of the overall supply of BTC that still needs to be liquidated for us to look anything like a top. Yeah. So, and given that we're seeing accumulation stepping in, it would not surprise me if this really started to soften in and maybe even set a higher zone here and we actually kept rallying higher, right? Because that supply sink is still very, very real. So what I'm kind of seeing here is I just don't think we're near the top, right? I really do think that there needs to be either another push higher and a mass long-term holder sell, or we may very well be seeing reaccumulation up here by some bigger players. That's telling us that we could very well still be in a very, very strong bull market. So I guess the story remains the same. It's very, very hard to have a bear case at this point in time, in all honesty. So what I wanted to do is, just before we close out, and again, here's that lower high on our liveliness metric, right? So there's just fewer coins being spent right now. Previously we saw increasing highs. So this is the exact same pattern we saw on our realized cap hodl waves. We have the exact same pattern of accumulation on our binary liveliness. So, to me, this is telling me there's accumulation still happening up here. Coins are maturing, not being spent. Long-term holders are clearly backing off their pressure. I just don't think that 58,000 is going to be a global top. So I think that's probably the take-home message from all of this. Let me just quickly run my, here we are, reserve risk. So just to close out, hang on. Just to close out, let's look at our reserve risk, which I think is a pretty interesting metric. Now, reserve risk is telling us a very similar story, right? It's kind of at this midpoint. This is an oscillator that's trying to tell us where the hodlers believe we are. And you can see here that we're kind of, I mean, you could almost argue midway, but this is kind of the second peak. We're kind of coincident with that same point in 2017, which would indicate, maybe we're going to push up for that 100,000 six-figure level before the steam really comes out of this. Now, the way that the reserve risk is calculated, what it's trying to do is capture how much opportunity cost have hodlers hung onto, right? At any point in time, all of us could go and spend our coins, right? Every single person who's holding BTC could go and spend their coins, cash out, and walk away for the day, right? And have a happy holiday. Now, what you can see, let's turn off this red line here. This gray area plot is essentially the dollar value of all the coin days that are destroyed. So what coin days destroyed is you withdraw 1 BTC, you hold it for 1 day, then you spend it, it's accumulated 1 coin day. You withdraw 2 BTC and you hold it for 1 day, they've accumulated 2 coin days, and then you spend them and they get destroyed. Now, if every single coin had 1 coin day and was spent, the coin days destroyed would exactly equal circulating supply. Because we know that some coins remain dormant, they accumulate longer coin days, you get these lower periods. So where it dips below the market cap or the price, this gray line, and you get these white bars, that's essentially saying that fewer coin days versus the circulating supply, there was more coin days created than coin days destroyed. What we do with this red line is take the 30-day median, and this is really telling us when you've got the red line that's a long way underneath the black line, more coin days are being accumulated by the protocol, there's more hodling going on, and there's less destruction going on. You can see that as we move up towards the peaks, you get, this happened in every single peak, you get more coin days being destroyed as a lot of those older coins come back into circulation, and they offset any of the coins that are not being spent. And you can see that we came up and we really touched these levels up through here as well. So it's telling us what are the old hands doing really? What is the gap between this red line and the current price? Now, the hodl bank is a metric that essentially takes, it assumes that this red line here, which is the median value of that coin days destroyed, it's telling us the opportunity cost. So at any point in time, we all could have cashed out, but many of us chose not to do that. So what ReserveRisk is doing is it's taking this cumulative sum of all that opportunity cost. How much could hodlers have cashed out, but they chose not to? It's basically like a big running total of how much value hodlers have chosen not to spend. How much opportunity costs have we built up over time? And therefore we have the current price, which is essentially the incentive to sell. We have the cumulative value of that hodlers have not sold. And you can see that the price floor, very similar to the realized cap, kind of accelerates through the bull market as more coin days are destroyed, and then levels off during the bear, and then re-levels up. And you can see that the distance between these, over time, it's self-correcting, it's self-adjusting. Even though we're in log space, we've got 2 grid lines, we've got 2 grid lines, and we've got 2 grid lines separating the hodl bank from our current price. And that's what ReserveRisk is doing. It's basically looking at what is the current price, what is the current incentive to sell relative to the opportunity cost over time, which naturally is self-correcting, much like the realized cap. And that's essentially what this oscillator is trying to tell us. It's telling us when are the hodlers, when is the price well and truly below the opportunity cost? And you can actually see that this is trending down, this is trending up, so the hodlers are still accumulating opportunity cost, even though price is falling. Eventually you move into this period of undervaluation, and then away you go. And what's nice about hodl bank is it actually captures a larger portion of the bull market. You can actually see that we've got almost the reaccumulation phase until we really start rallying north. And it very much is a smooth oscillator. I mean, you can even see almost the entire plus token thing, plus the March sell-off and this early phase through here was all green light, right? And only now we're starting to seriously accelerate. And that's a result of our hodl banks spiking up and more coin days being destroyed. So it really is capturing hodler sentiment in a very, very strong and real way. So overall, I like ReserveRisk because it's got a lot of fundamentals baked into it. It really is capturing, and it's a self-correcting metric that I think is going to withstand the test of time. And, you know, overall, it's telling us a pretty coherent story with what we're seeing on chain. So, you know, I think if you're going to take anything away from this particular session, understand a little bit more about what ReserveRisk is telling us. It really is giving us what the hodlers care about, and pay attention. I might do a write-up on this for Glassnodes. You're the first people to know, but this is a really, really interesting trend. It's showing us that those 1 month coins are maturing, It takes time for this to happen. And ultimately, when we were back here on the hard right edge, we could not have told this. Now we really can make a distinction that we're actually getting older coins that started being accumulated back in at 57,000, so post Elon candle. So that's the update for the week. I will catch you all in the chat room and then again on Wednesday. And stay tuned for the Week on Chain newsletter, which will come out on my Tuesday, your Monday. Cheers.